6% higher. There is a survivor bias going on, it seems to be on the high street here,
Yes.
that if you are still on the high street, you are benefiting from those closures.
Yes, I would agree with that.
Grace, we'll leave it there for the moment. Thank you very much. Coming up on the show, we'll be joined by the CEO of AMS, says the Apple supply offers an upbeat outlook for its second quarter. At first, an interview coming your way.
I'd like to donate these books.
Thank you very much.
Where'd you get that book?
A man donated it.
Yes? I'm sorry.
But I need to retrieve...
I want to leave you looking for this.
No. Thank you so much.
Return the book.
Sir!
Our plan is to continue to expand. The vision is to achieve top 5 QSR companies in the world. We are looking at two-pronged strategy. One is to have a strong organic growth and at the same time strategic acquisition. We identify 3 pillars, which are the Philippines, China, and US, because these are one of the big economies in the world. And we intend to replicate the successes of the Philippines in China and US as well. We are open to explore new acquisitions, and our focus is on companies that have strong superior product and that has potential to grow. So the concept should be scalable, and the reason why we acquired Smashburger and Tortas is because they fall into that category, not only in the USA but also outside the States.
Apple shares rose in extended hours after the tech giant reported a slide in second quarter earnings but met expectations. Revenue for the period also beat Wall Street forecasts despite a 5% drop compared to the previous year. The iPhone maker was boosted by signs that a slowdown in China was easing, as well as a strong performance in its apps and music streaming services. AMS offered optimistic guidance for the second quarter on the back of increased demand from Android smartphones. The Apple supplier also said it expects revenues of between $390 and $430 million as it hopes more devices with its 3D optical sensors will be launched. The Swiss-listed tech group suffered a net loss in the first quarter. Joining us now is Alexander Everke, who is the CEO of AMS. Alexander, nice to see you this morning.
Thanks for having me.
Terrific stock performance yesterday, 21% in one session. The numbers coming out before Apple reported as well. Just give us a sense of why the numbers have beaten in this quarter, but also guidance has looked pretty strong now for the next quarter.
Yeah, so we had a very cumbersome last year because of very uncertain market environment. In the first quarter, we could deliver $300.2 million revenue, which was above our guidance, or high end of our guidance, and above expectations. We delivered 6% adjusted EBIT, which was a turnaround for us, especially when looking at the second quarter, the guidance of the second quarter. We see a good momentum in our business to diversify the AMS business with our Android business. We did multiple design wins for 3D sensing, for color sensing in the Asian market. And we are looking very confident in the future that this continues to grow in the course of this year.
Many people think that if you look at the marketplace at this point, that we may have gone peak smartphone. Doesn't matter whether you're supplying to Apple or Android. That time has now passed us by, where we've seen the best of the smartphone market, which brings in other stories such as wearables, speakers. How poised are you to capture the growth in that part of the market?
What we do is we are developing products for one volume application first, in many cases the mobile phone, but then we use those technologies for IoT business, for the industrial business, and also for the automotive business. And this is a clear strategy of AMS to diversify the business, to be less dependent on a few customers or on one or two market segments.
The cycle is fascinating to me, because we looked at the Samsung first quarter results, and what they told us was terrible. Profits down. A lot of this is about the memory chip business. You're not so key to the memory chip story, are you? You're in optical sensing, and you're all different types of chips.
Yes.
So they have said they're going to spend $115 billion, I think, over the next decade getting into your business. Does that make you nervous?
No, because competition is there all the time. But what we have done, we have designed the company around sensors. And the reason for that is the sensors are the fastest growing market segment in semiconductors. And we make the difference by differentiating technologies, very innovative. And we see this with recent product launches, that we launched ambient light sensors behind OLEDs. So you don't see the sensor anymore. And with those innovations, we capture market share. And whether the market in the mobile domain is growing or not, we are gaining market share. And this is why we can give such a positive guidance for the second quarter.
Can I ask you then about competition from the Chinese? Because it seems to me that in this area of optical sensing and recognition and so forth, they are very aggressive at the moment. How do you beat them when it comes to the global marketplace?
By rigorously driving innovation. And this we have done for the last 2-3 years. And when you look at our portfolio, we make sure everything which is differentiating we own. And we have a one-stop shop methodology that we offer complete solutions to customers. And when you look at the 3D sensing, our focus is the illumination. We are not doing only a VCSEL or one component. We provide subsystems to customers, and this makes the life much easier for them. And more importantly, we can, by having this methodology, we can optimize single products, which our competitors cannot do because they don't understand the full system and they cannot supply the whole product.
I admire you for trying to take volatility out of your stock price. I don't know how you're going to do it, though, and I just want to pursue that one more area. I know you've already addressed that, but you were, in late 2016, you were around about 26 Swissy, 28 Swissy. You've then went up to 118 Swissy at your high. Then you went back down to 22 Swissy at your low, which was on the 4th of January this year. Now you're almost double that as well. Yeah. The likes of Temasek and Oppenheimer, who are your biggest shareholders as well, do they ask for less volatility in your share price? Do they say, look, guys, it's a great story when it works, but my goodness, we want to ride?
Well, they ask, and we want to make it less volatile. Yeah. And the way to do it is to diversify the business, to be less dependent on single customers, less dependent on single market environments. And that's why the gain in the Android business is so important. We see a significant growth for the future in automotive, where we apply the technologies we deployed in the mobile space now into the automotive. And what is so exciting for that? Because these are applications which doesn't exist today. Yeah. If you look in 3D LiDAR, in cabin face recognition, in decorative lighting, these are applications which does not exist today to the extent in the automotive industry. So the growth is so much easier than taking market share away from someone.
Yeah, and I used to think automotive, and you can trade at a big premium to the OEM, and it was a no-brainer. Then I saw the problems that Jack Aschenbach has had over at Valeo, trying to put new tech into cars, and it is a volatile ride as well, though. That's the problem.
Yeah.
One more question for you from me, if I may. Just you're an observer as well as a participant as well. When I see what's going on in China, I always raise a suspicious eyebrow when people tell me it's because of the trade war. That's why we haven't sold as many. And I know everyone's blowing, well, I should say, saying nice things about Apple today. But their sales in China were still down 22% in the last set of figures, down from 27% previously, so better but still appalling. Who's winning in China? And is it because of trade war or is it because of something else?
I think you're winning in China if you offer the best products and best solutions.
Best product and price?
Well, it has to be competitive, but if you
Apple
have
made the wrong decision on price, then did they?
This I cannot. You have to ask Apple.
You're so right.
But you sell into Huawei and Xiaomi.
Yes.
So could you share with us a little bit about that experience? Because here we have, I think it was a story yesterday suggesting Vodafone, I think it was reported by Bloomberg, saying Vodafone had found back doors into some of the Huawei tech. So Huawei is very much under the spotlight at the moment. Is there an element of blowback for you? Because on the one hand, it's a good sales story, but on the other hand, guilt by association.
Well, look, we are focusing ourselves on what we can control. And Huawei and many other Asian customers are very good customers of us, very innovative companies. And together with them, we create solutions which does not exist in the market today. And I think this is a very important message from us, that we can grow in the Chinese and Korean and Asian market with those customers. And we see the business as a global business.
Alexander, we're going to leave it there, but I can say you're okay, because when you answered that question so diplomatically, your colleague over there, I don't know if he's head of communications or something, he was nodding approvingly. He's like, yeah, we didn't step on one there as well. So really nice to see you. It's true. I mean, Grace knows what it's like. If you say the wrong thing, oh my goodness me, those comms guys, they've got to earn their salary somehow. Alexander Everg, nice to see you, sir, the CEO of AMS, and congratulations on the move yesterday as well. Taking a short break, 33 minutes to go before the start of European equity markets. Look, the FTSE futures called 5/10 to 1% higher. It's May Day!
Explore key trends driving today's iron ore steel industry and how they shape market development. Join us and industry leaders at Asia's premier iron ore and steel event. Visit ironoreweek.sg for more information.
Start on top of the news. Global markets. Ahead of the game.
Time for this morning's big money stories.
Brian Sullivan, Worldwide Exchange on CNBC. Opening bell action.
Global markets under some pressure this morning.
Financials are the best performers right now.
Is there a risk here? Look at these stocks.
Squawk on the Street. Weeknights.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, Morgan Brennan, John Fort. Squawk Alley on CNBC.
On the next, Managing Asia, saving the planet through architecture.
Now it is a race and rescue mission. If we don't do something about it now, there won't be that many next generations to survive our generation. If we were to integrate our built environment with the natural environment, then our buildings and our cities must be like nature.
World-renowned green architect Ken Young on the next, Managing Asia.
Get CNBC Pro for in-depth access to Wall Street, giving you the edge to invest like a pro. Pro's got global daytime coverage with live streaming of CNBC US, Europe, and Asia. Your subscription gives you access to the experts who do it best with exclusive interviews. Get insights and analysis from the pros, plus big market data analyzed to help you uncover new investment opportunities. Invest like a pro. Go to cnbc.com/getpro for your 30-day free trial.
Reporting on the Federal Reserve is one of the pillars of CNBC's coverage.
You guys ready? Here we come. Let's get to Steve Leisman with the Fed decision.
Up by 1/4 point.
Put up the Dow. We're up 250.
Obviously, the market reacted to it.
New Chairman Jerome Powell will hold his first news conference this afternoon.
Leisman gets the first question.
Where's your biggest concern here? Is it in overkill when it comes to rates? There's very little that moves the markets as consistently as the Federal Reserve.
Give me Treasury.
I feel tremendous responsibility both to get my reporting right and to get my analysis right.
Welcome to Squawk Box. If you are just joining us, here are your headlines. Apple spikes in extended trade as stronger demand for services helps offset declining iPhone revenues, and the tech giant delivers a new $75 billion buyback plan. Underlying sales fall for a second straight quarter at Sainsbury's as the British supermarket vows to ramp up investment after its bid to take over Asda fails. CFO Kevin O'Byrne tells CNBC the company is in a strong position despite tough market conditions. President Trump says the U.S. economy could go up like a rocket if the Fed cuts rates ahead of the central bank's latest policy decision today. And violence erupts on the streets of Venezuela after protesters clash with government forces as opposition leader Juan Guaido calls on his supporters to rise against President Maduro.
President Trump has put more pressure on the Fed to cut interest rates. The president tweeted the U.S. economy could, quote, go up like a rocket if the central bank sharply cuts rates and restarts QE. This ahead of the Fed's latest policy decision today. The central bank is widely expected to keep interest rates on hold and stick to its patient stance.
Meanwhile, Trump's Fed board pick Stephen Moore is facing growing opposition from Republican lawmakers. Senator Lindsey Graham said Moore's nomination would be, quote, very problematic. Elsewhere, Senator Yoni Ernst said she would be very unlikely to back him. Moore addressed the criticism in an interview with CNBC.
The question I would kind of ask my critics is, why are they so afraid of me? I mean, why are they so afraid that someone with my views will get on the Fed? And I think partly it's because they think I'll be an effective communicator. I want to make Chairman Powell the most successful Fed chairman in history, where we do get 4% growth.
Respondents to the CNBC Fed survey see the S&P topping 3,000 points by 2020. Steve Leisman has more.
A three-handle now predicted once again for the S&P 500. What I want to show you here is the track of the forecast going back to September of last year. You can see right now we're about 2935 on the S&P, going up to 2974, so not much further to go, according to our 45 panelists here, and 3028 is what we hit next year in 2020. But you can see back in September, we believed it was going to be over 3,000 for this year. We've gotten most of that back, but not all of it. But watch what's happened to bonds. Very interestingly, you've come down. You were at 3.5 on a prediction for the 10-year yield this year. That's come down, 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 and stayed down. So while stocks have come up, the outlook for bonds has remained lower. In fact, this is quite incredible. You see over 75 basis points of easing coming into the 10-year yield in terms of expectations of lower interest rates. One reason why you may have this bullish outlook in the market is expectations for a trade deal. 77% of our fund managers, strategists, and economists expect a U.S.-China trade deal to happen this year. 79% say there will not be another government shutdown, or at least that is unlikely. Some of the commentary that we've received here, Scott Wren, Senior Global Equity Strategist, writes, what the market needs is a reasonable trade deal and signs that Eurozone GDP growth isn't going to drop further. SPX, the S&P, is modestly undervalued, but the expansion is not over. However, Michael Painshaw, Director of Research at Market Profile Theorems, writes, equity prices relative to valuation, interest rates, and technical conditions are extended. That's how we have a market, folks. Now, I want to show you what's happened again to the Fed funds rate outlook. This is what it was in December for each year, going up around 2.8, ending 2.7% in 2021. That's come down. Again, easing working into the market, and all of that helping out the outlook for stocks. Back to you.
Thanks very much, Steve Leisman, with that review of the detail. Grace, let's come to you here. It's fascinating watching what President Trump's doing on Twitter around the Fed, because it puts him in the company of people like Paul Krugman, the Nobel laureate, who is no fan of the president, but also has been arguing that the Fed was wrong to hike rates and that recession is imminent, either later this year or early next year. You feel a bit of pain for Jay Powell, really. What is the Fed to do at this point, and what signals do you think we need to see over the course of this meeting to feel reassured that equities remain the right asset class of choice?
Yeah, I think that the main change that we've seen from the Fed is thoughts around where the neutral rate is, and therefore what further hikes would mean for the economy, and obviously the trajectory of inflation within that. And so to that point, the fact that core PCE came in lower than expectations, 1.6%, is actually helpful as we go, sort of into the next Fed statement, and implies in our mind that they're still very much going to be signalling that they're on hold. That is constructive for equity markets. Undoubtedly, the re-rating that we've seen in equities this year is a repricing of risk, and a large part of that risk is around Fed and monetary policy, the other part being around trade, as the previous section touched on. But our sense is now that equities are approaching fair value. And so therefore, when we think about risk factors both to the up and the downside, trade certainly features, i.e. a reignition of global growth, a V-shaped recovery rather than just a stabilization here, but also the Fed. So, it's a real fine balance between a rebound in economic data and financial markets and the Fed's ability to both support or indeed curtail that.
We've also travelled a long way on particular stock names that are very heavy when it comes to market cap. I mean, Apple, 27% over the course of this year so far, 47% on Facebook, Amazon's been up 28%. If the sector can't do more lifting, if there's not more to the upside, then it does present a challenge for the overall stock market, doesn't it? So what is your view on tech?
Yes, it does. So just on the market piece, first of all, technology is obviously a big overweight in the US, and it's also been a big driver of margins. So when we think about US earnings overall, but particularly the operating leverage and the margin piece of that, tech is critical to that. We've been long supporters of the tech sector, and that remains the case to us. We see structural drivers within technology. We spoke previously around the consumer piece, smartphones, and actually we think the next 10 years is really going to be about enterprise and businesses probably on a slower trajectory to the consumer, but business adopting, whether it be cloud technology and various other technologies to drive that forward. I think, when you look at year-on-year earnings growth for tech, last year the sector delivered about 25% year-on-year growth, and the market was very concerned about margins, particularly through the back end of the year. What we've seen through the first quarter of this year is growing confidence around a 10% earnings growth number for 2019, much lower than in 2018, but still double the market, and that has afforded tech companies the rally that you alluded to. So we think that can continue broadly.
But what you suggest does hint at some leadership change in the tech sector, because only one of those companies really leans into the enterprise, and that would be Amazon through AWS. The rest sort of would lean towards, say, Microsoft, IBM, Salesforce, so other stocks. Yes. To look at in the tech space is what you're saying.
That is absolutely true. But even in the consumer space, we still see, or the consumer-focused tech names, we still see upside. And what's been interesting through the last week of reporting is that whereas the market was focused on margins, actually revenue growth has come out as one of the issues, positively or negatively. And we've seen a return to talking about innovation, customer experience, data protection as key themes coming out, which really is an evolution to us in the maturity profile of these businesses, and again leading back to the rating therefore that you would apply to the profit streams.
How do you make money then? If we're range bound and you think we're fair value, that makes the rest of the year look quite difficult for active managers or our smarter investors who would like to find some hidden value or opportunities maybe on pullbacks. Are we going to get those pullbacks, do you think, and what will be the causes?
I mean, pullbacks happen in markets 5 to 10% per year. One 5 to 10% pullback per year is really quite typical, and obviously we've been quite a long run since the start of the year where we haven't had that. So we always sort of think that can happen at any point. We do think a range-bound market from here, and at JP Morgan Private Bank, a lot of our clients have the luxury of thinking longer term. So a lot of the conversations we engage in is, what will I care about over the next 5 years? And obviously, whilst market moves on a month-by-month basis are still important, we're thinking longer term than that. Technology feeds into that. Healthcare is another theme that obviously has got some political overhang in the short term, but that can actually provide attractive entry points into a longer term story around demographics. Merging again sort of with technology, greater healthcare and technology overlap. And dividends are also a reoccurring theme, particularly for euro-based investors. It is so difficult to get yield, and it's one of the key advantages that the European stock market has, and that it does pay a dividend.
Yeah, just on one of your points you raised, the democratic healthcare story. I do struggle sometimes when I hear what it should be, and people like you talking about it, and then I look at what the numbers were from Philips last week and how underwhelmed I was by what Frans van Houten had showed us in terms of some of their diagnostics revenues and difficulties there. But maybe we'll come back to this, because we have got to move on, if we may, at the moment. My Venezuela reader's gone, so it's you.
OK. Coming up on the programme, shares in Apple shoot upwards after hours, despite the tech giant reporting a fall in quarterly earnings. We'll have more details on that when we return. Plus...
Oh, if you can't get enough of me, and the other two, you can surely tune in to our very own podcast with Karen and Jeff especially, of course. Head to cnbc.com, Apple Podcasts, Spotify, or wherever you get your podcasts from. Down Walthamstow Market, maybe. And have a listen to download today's episode. It's a goodie.
This is Stephen. You probably know him better as that guy from work.